Okay, so welcome everybody. This is the forecasting workshop, planning our future. So I don't know whether you've crumbs. I don't know what you think about is going to happen with the future ahead of us, but I'm always a big believer in if you don't know where you're going, any road's going to get you there. I think that was one of Mao Zedong's sayings, and so it's up to us to actually plan our detail. And one of the things that's been coming through from our banking colleagues is that they are not seeing much detail. So yesterday's world of business was great, and believe it or not, this picture was taken the other night. It looks like the Serengeti Plains, but it's actually on Eastbourne, of the Downs, just up the hill from where I live. The sunset was absolutely glorious, and I just thought, well, I'll use that because that's like the gold of yesterday. And so the challenge for us is to think about, can we actually get up create our own new diamond for the future? Because the new normal, whatever the new normal is going to be, and be a brave person, anybody who wishes to predict it. We've just got to be, I think, without being negative, we've got to plan for the worst and hope it doesn't happen. So we've got to be thinking and do all the what ifs that we can and plan for it. And so the whole idea of this forecasting workshop is to give an idea, because our banking colleagues are saying that where people are applying for funds, they're surprised how little detail is coming into their applications. So what we're going to see today is actually a totally comprehensive tool that is available to you free of charge. It's part of a wider suite of software that we're working with as part of our Virtual Finance Director service. But this is one is just trying to help people so that keep people in business, keep people alive, and making sure that they're planning the right things. So why are we here? Well, we're going to try and help you create a 5-year plan. I'll show you how easy it will be to do with the 2 detail years and then 3 summary years at the back. It's hard enough to think about 12 months in advance, let alone 5 years in advance, and try to and show you how to present a report that is what the banks will be impressed with and will accept as up to the standards that they require. So we're going to talk about a universal model, but those of you, like I was saying to Tracy, who is already on Xero, this model integrates directly with Xero. So anybody who is on Xero, we can help pre-populate the history on the model, which you'll understand when we go through the presentation. In June, there will be an opportunity for anybody who's on Sage to have their Sage pre-populated. And by July, it might be quicker, also QuickBooks Online will be coming on board as a totally integrated solution on that. So our promise to you is we're going to help you with the planning and the forecast, show you how to do it. We're going to give you a nice planning tool that you can use. And then what we'll also do is we'll give you the generation tool that will generate the report for the banking world, should you wish to use it. And we're going to give you a couple of other nice little freebies as well. So a risk analysis tool to give you an opportunity, and possibly a cost reduction tool or utility tool. So our agenda: show you the templates, show you how to put in historic data, how to create your baseline forecast. So in other words, what's actually there based on your existing information and whether that's relevant going forward. As we say, for the diamond in the future, is that going to be relevant for us? Are we going to be like our golden past or not? There'll be a forecast balance sheet, forecast cash flow to reflect the impact, and there's some what-if analysis where you can introduce different scenarios that will be in there. And the total reports there will allow you to not only hopefully apply for funding should you require it. A lot of people haven't, in our experience yet, applied for funding, or some have just applied for the bounce back loan on the hope that it's going to be all right. And I'm really conscious I don't want to appear negative because I'm not, but I just think the problems haven't even hit us yet. We haven't even scratched the surface. So I hope I'm wrong, and I hope that they keep printing money and they throw money at it, and so a little bit of inflation will be the least of our problems if that happens. But it could be that we are in for a 30s crash, and if we are, we've got to plan for it and do the what if, and show that we're ready for it and we're planned, because there's so many businesses who are they haven't even talked about laying off people, because the furloughing has helped them, but I think there's some really difficult situations ahead. So that's why we have to look at it. So look at the opportunities available to us. But thankfully, it's not going to be me at the moment who's going to be sharing all this information with you. We've got an expert at hand, somebody who's helped prepare the model, knows it off by heart. I've heard him for several weeks in a row, and he gets better and better every week as he shares it with you. But I've got to warn you, even if you're an accountant, and there's several accountants on this call, when I first heard this, I thought, oh my God, this is like overwhelming. So Tracy, you're an intelligent lady. I'm just going to pick on you. Don't feel worried if you're overwhelmed, because when I first listened to this presentation, I was totally overwhelmed. But it is really logical, and it's quite simple. You'll be given the copy of the model, and you know where to call if you need help when you're looking at it. So
great, thank you.
Don't feel at all worried, anybody, if you suddenly think, God, where do I go? There's opportunity for questions at the end anyway. So let me stop sharing, and then Mark will share his screen. So I will mute myself, and everybody else just can be muted and unmute at that stage, at the stage of questions. So I'll mute everybody just so that we don't interfere with Mark, and mute myself. Okay, over to you, Mark.
Thanks very much, Mike. Yeah, you haven't muted me, which is good. Can I just get a head nod, a thumbs up, if you can make sure you can see my screen? Brilliant. Okay. So, hello everyone. As Mike said, the purpose of the next 45 minutes to an hour is to just go through exactly how you would prepare not only a forecast for your business, which is probably an exercise which should be done on a quarterly or 6 monthly basis anyway, but also how you turn that forecast into a funding proposal to be presented to a lender if required. So the first part of what we're going to go through is the process, in my view anyway, that you should just go through in business every 3 to 6 months. And then obviously the outcome of that determines whether you need funding or not. We're going to go through, as Mike said, the universal model. And also, as Mike said, if you are on zero, Mike's team can help you get the data into the model. So the first section of what I'm going to talk about, fortunately for yourself, you can choose to listen or not listen to, and then from the model is the same for both from a certain point on. So I'll start off, when you open the model up, you'll get a process tab. I'm not going to talk to the process tab because I'm going to talk through it as I go by each of the tabs, but essentially everything you need to know about what to do within the model is there on a process tab for you, and you can just go through the steps, use it as a tick list. Have I ensured that I've done the necessary steps on that list? So a really good tick list to go. Some of the elements of it you might not need to do, but a really good list to just go through and go, have I done that? Tick, 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 tick. So the first thing we're going to do is look at how I import data into the model. Now this will become hopefully less relevant for you as time goes by, because at the moment, if you're on zero, this is already done for you, or Mike's team can do it for you. And then if you're on Sage, within a couple of weeks, Mike's team will be able to do that for you, and QuickBooks, again, 4 to 6 weeks later, that. So hopefully this is becoming less relevant, but I'll go through the steps you need to go through anyway. So to import data, that's the first step we need to do. We have a sample P&L and a sample balance sheet, which are two of the grey tabs on the model. The next two tabs after the process tab. And all they do is they lay your data out in the format that you need to lay out the data to import it into the model. You can't actually do anything on these tabs. If you click on it, you'll get a message saying you're not allowed to. All this is doing is saying your data needs to be structured in this format. And for the P&L, it's really simple. My first column needs to include my P&L lines. And then every column thereafter needs to include data for a specific month, starting with the most recent and heading backwards in time the further right I go. So it completely depends on which accounting system you use with regards to how it will present the data to you. As an example, I think Xero presents it exactly in this fashion. I think Sage presents it in the reverse order. So it's about a 50-50 split between the packages. So there's my P&L. That's how it needs to be structured. I've then got a balance sheet, which is just 2 columns. I've got one column which has got my balance sheet lines, and I've got another column which has got my balance sheet balances, and all you need to do is make sure that these balances are at the same date as the most recent month within your P&L. So that's how you structure your data. And then what you need to look at is, okay, well, now I've structured it right, how do I now incorporate that data within the model? Now, I've already pre-populated these 2 tabs with the information that I've already prepared. And all I've done here is I've input my P&L lines in the yellow column, and I've input my values starting with the most recent month in the orange section. Now, all throughout the model, you'll see these little red triangles, which are tooltips. So if I'm ever unsure of what to do in a particular column or a row or a cell, then I just hover over the tooltip and it will tell you what you need to do. Again, all of these elements are on the process tab as well. So you're never too far away from being able to access information and help. So I've pasted in my P&L lines, and I've pasted in my my values by month. A few other things I need to do on this particular tab. I need to give my company a name and change it from Demo Company Limited. And then I need to just tell the model what the most recent month is. So in this example, it's March 2020. But if I've got data which is up to date to April, I just change the month to April. And all that does is it sets the current month, but it also sets the historical months as well. You can load up to 5 years worth of data within the model. And that history is important because that history feeds through to the funding proposal. So a lot of the feedback, as Mike was saying, is around the detail that the funders are being provided just isn't good enough. And what they look for is the criteria. They look for 3 criteria really. It's how was the business performing, i.e., what's the history of the business telling us. What impact is COVID-19 going to have on the business? And then is the business going to be viable in the medium term after that? So the historical element is captured here. And this is the only time you'll use the 5 years, and that will feed through to the report. So the more history you put in, the more detail you've got around history, which will show up in the report. All that's then left to do is for me to assign a category to my P&L structure. And that's really, really simple because most P&Ls are presented in exactly the same way. As you start with your sales, then you've got your cost of sales, and if relevant, and then you've got your overheads. So all you then need to do is select the appropriate category by the particular nominal. And again, if you're ever unsure of what this blue column's for, hover over the tooltip and it will tell you what to do. So select the chart of accounts category next to each P&L nominal, being sure to exclude any headings, subheadings, and totals. They should be left as select category. So all you're looking to do there is categorize the nominals, and I want to exclude all of my totals. As I've tabbed down, I've done the same for cost of sales, and I've done the same for overheads as well. So that's my P&L structure set up, and then that is all going to pull through to the model as long as I've followed those steps. Balance sheet, very, very similar. I paste my balance sheet lines into the yellow column, and I paste my balance sheet balances at the same date as my most recent month into the orange column. And again, I need to categorize these lines now, and these lines are categorized as either fixed assets, current liabilities, long-term liabilities, or shareholders' equity. And again, most balance sheets are presented in this order anyway, so it's really, really simple to follow. I will highlight one issue which you may come across is you may have what we call floating nominals, and it completely depends on how you set up your accounts. And a floating nominal, all that means is the where that nominal is positioned in your balance sheet is dependent upon the balance. So the easiest example is bank account. So bank account here, it rolls up into current assets because I've got a balance of 26,500 in my bank account. If I were in my overdraft and the bank account was set as a floating nominal, it would actually appear as a current liability. All I would then need to do is you need to categorize it as to what it would ordinarily be classified as. So if my bank account was appearing as a current liability, all I would need to do is change it to current asset here, and that would mean it would flow through into the correct part of the balance sheet. So I'll just change that one back. So that's my data setup done. I've set my data up, I've pasted the data in, and I've classified the lines. As we've said, if you're on Zero, Mike's team can help you do that work and pre-populate that work for you. So all you'll be presented with is a model which starts with a tab called Baseline Forecast. So the principles behind the model are I set what we call a baseline forecast, and that's everything I am expecting to happen within my business over the next 5 years. So my known trading performance, and the example we're going to go through today is where COVID-19 is going to impact a business that has to close for a period of time. Okay, so we know that's going to happen. So we're going to try and reflect that in our forecast. Once I've understood what is going to happen from a trading perspective, but also from a cash flow perspective, that will then determine whether I do or don't need to apply for any type of funding. And then if I'm going to do that, I then use the funding tabs, which are the blue tabs. You can use the model to simulate any type of funding. The one we're going to use today is to mitigate a short-term cash flow deficit. But if you want to use it to invest in new machinery, or if you want to use it to invest in a new sales force, then it's just as capable of dealing with those scenarios as well. So the first thing that you're presented with in the baseline forecast is the lines which you've entered on your monthly P&L, ranked by value over the last 2 years. So it doesn't matter how you rank them or how they're presented here. The model will just rank them for you with the highest value line coming at the top. And you're presented with the history over the last 24 months. And that history is there to help you understand and help you determine how you're going to forecast those lines going forward. I'll just explain, we've got sales nominals 1 to 9 here because we've categorized sales nominal 1 to sales nominal 9 on our monthly P&L. If I were to change sales nominal 1 back to select category, what you will find is that nominal now doesn't appear in that list. And that's why we say next to the totals, leave it as select category. So I'll just set that back to sales. So that will now appear. And now we've got our 9 nominals back. So there's my history over the past 24 months. I can therefore see by each of those categories. Now, I've chosen to import my my history as a sales nominal. If you've got it by any other way that you want to represent it, you can represent it however you want. You can represent it by key sales channel, by key customer. As long as you've got the information, you can paste it. You can paste it into your monthly P&L. So for this particular line, as an example, this year I've achieved £215,000. Last year I achieved 205,000, so therefore I've had a 5% improvement year on year across that particular line. You'll see that in this particular business we've been unbelievably consistent and achieved a 5% increase across all of our sales nominals. We're also then presented with that performance in each of the last 4 quarters, and you'll see we've been even more consistent because we've achieved 5% in each of the last quarters across each of the lines. Real life examples will clearly be very different to that. What you are then presented with is, and I've already pre-populated this for speed, so I'll just show you what you would ordinarily be presented with. What you're ordinarily presented with is as the top line is showing here. So you'll have a percentage applied column, and in that percentage applied column will be your performance for that particular line over the past 6 months. Because your starter for 10 is, okay, or if I just do what I did over the last 6 months going forward, what does that mean for my business? So what this is saying is that if I've achieved 5% growth over the last 6 months, year on year, if that 5% continues, what would each of the next 12 months look like? And all it's doing is saying, in July, as an example, take what I did last July, uplift it by 5% and reflect that number here. If I want to change that assumption, I can do. So I've just put 15% in, and that will then change all of these numbers to 15%. And they've all turned orange because I've changed my assumption from the standard assumption of the last 6 months. If I want to put a minus figure in, so minus 5%, I can do, and that would reflect the same. What I can then do is, if I want to, I can go into an individual month and I can key a number in. So it might be that I want to apply 5% across most of the year, but there are a few months actually which I want to reflect a bigger or a smaller increase, in which case I can do that. So that's how you can input your forecast. You can either put it as a year-on-year percentage to apply across all months, or you can key in specific numbers in specific months for a specific line. I'm just going to reset everything that I've done. So the model's in Excel purposely because everybody loves working with Excel and can understand. So all I've done there is I've just clicked undo. If I am planning some new sales channels or any sort of new sales activity which doesn't roll up into my existing, in this case, nominal structure, I can put that in this orange. I can put that in this yellow section here. So it might be that I'm building a website and I'm going to start to generate some website revenue, in which case I would just do that and input that as a new sales channel or a new customer, or however you want to reflect that in the yellow section below. I'm going to stick with it as I've already pre-populated, and all I'm showing here is a business that has had to close for the next 4 months and then is slowly going to rebuild based on a proportion of the previous year's revenue. So actually this business doesn't get back to achieving normal, whatever normal is, or last year's performance until June of the following year. So I've already pre-populated that forecast. Again, like I say, for speed, you'll put a lot more thought into that. But essentially what we've got now is we've projected performance forward for the next 12 months. And we're going to achieve £273,000 worth of sales, which is 70% lower than that achieved in the previous year, which was 931. So a heavy impact on sales. Then what we do is we go on to forecast now that the next 12 months, i.e. months 13 to 24. And again, what we've assumed here is that we slowly get back to the point where we are achieving similar levels of revenue as we did in the previous year. So what we've got now for year 2, we're still on our rebuild, and we're getting back to, we're now generating £814,000 worth of revenue. And then for years 3, 4, and 5, you either put a year-on-year percentage increase in, or you put an absolute figure in. So again, if I want to apply a 15% increase in year 3 for this particular line, I can do. If I want to just key in a number, then I can do. One point to note is that once I've keyed a number in for a specific year, I can't then go and change the percentage because that won't impact it. So it's one or the other. So again, I've just made some numbers up for years 3, 4, and 5, but we've now got a business that is getting back to, by year 5, the revenue position that it was at last year. Again, different businesses will experience different trading circumstances. So we've done our sales forecast. Now we need to look at our gross margin forecast. And the way that we forecast gross margin within the model is looking at gross margin percentage. And we apply that percentage to our sales figure. So again, we've got our history that we loaded, which tells us that over the last 12 months, we generated 71% margin rate. And that was 1.4% up on the previous year of 69.6. We're told what our margin rate has been over each of the last 4 quarters. And then we're also given a view of what the margin rate achieved has been over the last 6 months. And that's the margin rate that the model will apply going forward. So as you see here, we've achieved 67.9 over the last 6 months. Therefore, I'm automatically applying that to each of the next 12 months. If I want to change it, I can. If I want to go back to my 71, I just put 71 in and it will change it. If I want to put an individual number in an individual month, I can do. And that will just apply to the total sales to generate your margin. I'm going to just revert back to the number that was originally in there. So what that's doing is applying the margin rate achieved over the last 6 months and just projecting that forward. And then you go on, you do exactly the same for year 2 and year 3, 4, and 5 by just applying the margin rate. And again, if you're unsure, you've got tooltips which tell you exactly what you need to do. So now I've got a position for this business where if I look at my history over the last 12 months, I generated £661,000 worth of margin. Now, because of my reduction in margin rate and my reduction in sales, actually that's going down to 185 or 186,000. So a 72% decrease in cash margin year on year. So it's not looking good over the next year for this business. I then come down to my cost lines, and I've already pre-populated my assumptions for ease, but I think that here you just basically need to reflect, in this particular circumstance, any cost mitigation that you can. So I'll just talk through a couple of them. So for the next 4 months, the £1,000 is the amount that I'm topping up furlough, just an assumption. And then my salaries are slowly building as my sales build, back up to normal levels next year. I got 3 months where I've been given some grace by the landlord. I'm not doing any travel and there's not going to be any motor expenses over the next 4 months. And other lines, I've reduced my spend over the next 4 months. So where possible, I've reduced expenditure. You'll also see that some lines will have a minus 100% already applied to them. And again, if you think, well, why is that? That seems a bit odd. Again, just hover over the tooltip and it will tell you why. So in this section down in the note, it says any nominals that have a description including depreciation, interest paid, or tax are automatically set to 0 as they are calculated on the 3-way forecast tab. So that's why you've got a minus 100% in there to set that to 0. So corporation tax, depreciation, and interest is all dealt with elsewhere in the model. So don't include them in your P&L, i.e. your trading forecast. One further point to note on this tab, or 2 further points, sorry. You've got the yellow section down here. The first line in that yellow section is bad debt. And again, why have I got a bad debt line there? I might already have a bad debt line in my P&L. So I'm going to hover over it. If you wish to forecast bad debts, please use the row provided. This will ensure the correct P&L, balance sheet, and cash flow treatment. So that's why you have to put bad debts in this line and not in the line that may or may not appear above. And then if I've got any other costs that I'm anticipating I'm going to be incurring, I've then got this yellow section down here, which allows me to add those costs as well. So once I've added all of that together, what I've got is a position where I had a profit of 241,000 last year. That profit is now going to reduce to 119,000 over the next 12 months. It's going to recover to 180 or 179 the following 12 months, and then to 200 to 220. And then only in year 5 am I going to be achieving around about what I was achieving in the past 12 months. Again, this forecast is for demo purposes. Your forecast will I'm hoping for the business's sake be a little bit better than that. So I've set my P&L forecast, and that's that. And if I just want to look at a P&L forecast, that's all I need to do. And then there's a forecast report, which will essentially populate all of those assumptions and will provide you with your trading plan over the next, at summary level, over the next 5 years, and at detail over the next 12 months. So if I just wanted to do a P&L trading forecast and produce a report, that's the report that I produce. And again, you click the button that says print PDF, and then it would just print a report out for you, which looks like that, to allow you to input comments if you wish. Okay, we're going to go further than that today because we want to understand actually the impact that trading has on our balance sheet and, more importantly, our cash position. So the next tab I look at now is my baseline balance sheet. What the model, again, has done is pulled forward all of the information that you've put on your closing balance sheet. So as an example, if I go back to my closing balance sheet, I have my bank account, which I've classified as a current asset. And if I look at my balance sheet, my bank account is appearing in my current assets. If I go back and I classify that line as a current liability, and I go back to my baseline, I've now got my bank account appearing in my current liabilities, which is the wrong place for it. But that's the impact that has. So I'll just undo that. So now I'm presented with my balance sheet lines in the correct categories. And I now need to select the treatment I want to apply to that line. And this is the treatment which is going to trigger the impact on the balance sheet and the cash flow and all of the working capital calculations. And you just need to select the treatment which best fits the line. So in this instance, that's really, really easy. So stock, I need to select between cash, corporation tax, debt, other, payable, receivable, stock work in progress, or VAT. You're given an explanation of all of those on the process tab. So here you're told exactly what will happen when you apply that classification. So stock is stock, receivable is receivable. I've got a bank account and a PayPal account, which are both going in as cash. I've got a rent deposit, which I've classified as other. And if you classify anything as other, all that assumes is that that value maintains the same throughout your 5 years. So anything which I'm not sure on, or not really, or doesn't really impact the current situation, I just classify as other. I then move on to my liabilities, and I've got payables, corporation tax, VAT, and some debt. And I've then got across on the right, I've got a long-term liability which relates to a court case, which I'm just going to classify as other, because I don't know what the outcome of that is going to be. So I just want to leave that off of this forecast. Now, once I've classified everything, I can then go on and actually prepare my the other element of my forecast, which is my non-trading element, which is the balance sheet and the cash flow. And that's dealt with on the baseline three-way forecast tab. Now, what we've got here is anywhere where there is a blue box will require an assumption. And that assumption, more often than not, will be pre-populated for you based on recent trends. So as an example, what the model does is it looks at your depreciation charge in your P&L, looks at your closing balance sheet for your fixed assets, and works out what your depreciation charge is as a percentage of your fixed assets, and it will apply that going forward. Now, if there is anything within your within your accounts which is created an oddity there, you don't have to stick with that number. You can change it to whatever number you want. So if generally we apply a 25% reduced balance to our depreciation, we will put 25% in there, but you're given a starter for 10. So I'm going to set that back and just leave that at 32.4. Then I've got any interest which is on existing debt. So we're not talking about debt that we are potentially going to apply for. We're talking about any existing debt within the business. And it knows there's debt because you've got an interest charge on your P&L, and you've also got a debt balance on your balance sheet because you've classified it as debt. And it's worked out that if I add all of the interest up and look at your closing debt balance, roughly you've got a 12.6% interest charge. Now, in this example, I've changed that just to show you that you can change it. And for this particular loan, I've got 2 months left on it. So I only want to apply interest for the next 2 months. And I've just changed that to 7.9%. And then I've set it to 0 thereafter. I'll come on to accounts receivables and accounts payables in a second, because they are accounted for below in the workings. If I want to make any changes to my inventory days or my stock days, I do that here. So this particular business is carrying about 150, 160 days worth of stock. So generally, if I increase that number, my stock will, the amount of stock I'm carrying will increase. And if I reduce it, the amount of stock I'm carrying will decrease. I just need, and obviously that has an impact on the working capital requirements of the business. I then come on to corporation tax. I've got a line where I recognize the corporation tax as it hits the P&L, and I've got a line that recognizes when I actually pay that corporation tax. So again, I've got an opening balance of corporation tax of 15,000 because I've categorized my corporation tax liability as corporation tax. And I now need to look at, okay, well, first thing is, okay, well, when am I going to pay that corporation tax? So I've assumed a March year end. So it's in my accounts now, and I'm going to pay it in December, because that obviously has a big impact on your cash position. Then what you do is you then work out, okay, what tax am I now going to recognize in my accounts based on my performance, and when am I going to pay it? And clearly Mike's team will be able to help you with this, because each business will have different tax circumstances. So all I've assumed here is that there will be no tax liability incurred because we're making a loss in the following year. Our profit in year 2 is more or less just about offsetting our loss, so there'll be no tax again. I'm not going to start to recognize tax in my P&L until year 3, 4, and 5. And as you can see here, the tax that hits my P&L in year 3 is paid in year 4. The tax that hits my P&L in year 4 is paid in year 5. So that's my assumption here. It may be different for your particular business. Then one of the most important pieces, how much dividends is going to be recovered or going to be paid to the owner. That's if they pay themselves through dividends. And here I've just assumed a monthly dividend payment. Obviously, if it was in lump sums every quarter or every half year, you just reflect them as and when they're paid. So £1,500 a month for the next 12 months, when they go up to £2,000 a month for the following 12, and they go up to £3,000 a month in year 3, 4, and then 5 in year 5. So I've just put in the assumptions there. So we've, as a business owner, we are showing that we are, as best we can, helping with the working capital requirements of the business by taking less in dividends. Any capital expenditure required going forward is then dealt with in the capital expenditure line. And again, if I'm unsure on anything, you've got the tooltips there which will tell you exactly what to put. So this is all planned, i.e. the purpose of this is all planned capital expenditure. So I'm closed for the next 4 months, so I'm going to restrict my capital expenditures to no expenditure over the next 4 months. And then I've just assumed £4,000 a month going forward. I then look at my capital element of my existing debt. So my existing debt, which I've classified on my balance sheet of £5,000. I've just assumed here it's going to be paid off in 2 months. So I've got £2,500 a month for the next 2 months, and then my debt is paid off. If I then go down to my balance sheet, what you can see is the impact that has there. So you've got your debt at 5,000, reduced to 2.5 in April, and then nothing by the end of May. And then if there is any equity issued or to be issued or any share buyback planned, that would then be reflected in the equity issued stroke repaid line. I've not assumed any in this instance. So I've set my overall balance sheet and cash flow, our balance sheet assumptions with some cash flow elements. So far, I've set my trading expectations. There are 3 other things that I need to look at. That's VAT, accounts receivables, and accounts payable. So the first thing we'll look at is VAT. And I need to account for the average VAT rate, both for output VAT and input VAT. So here I've assumed that everything in this business is VATable, in which case, so my average rate is 20%. And then I've assumed that my average input VAT rate is 18%. Now we are slightly going to change the way we do this going forward. So within a week, that'll be slightly different. It'll be a lot easier for you to do rather than trying to calculate it yourself. But for now, if you download this model, essentially you'll get a note in each of the tooltips which will tell you roughly how to calculate that number. What the model then does is then works out your VAT liability at month by month. So it knows what your opening VAT liability is, because again, you go back to your balance sheet, you've identified it here as your VAT liability. It knows the revenue that you've anticipated in that month, so April, none. It also knows your expenditure that you've anticipated for April. It applies the appropriate VAT rate to it to work out what your net movement in VAT is. Now, clearly, because there's no sales in this business, but there is expenditure, our VAT liability is going to reduce. And it just works that through month by month to work out what your balance is at the end of the month. Then all you need to do is select your VAT cycle. So this business, as an example, is a February, May, August, and November cycle, which means that the assumption is at the end of the cycle, your VAT liability is paid in the following month. So my next VAT quarter ends in May. At that point in time, my liability will be just over 6,000, and therefore that will be paid in June. Now, if you have a different scenario, or you're on a VAT repayment plan, or you've got 12 months where you're not paying any VAT at all, you can just delete it. And then it will just carry over your liability until you hit a payment point. Now, what's happening at the moment is we've got some businesses that are taking advantage of 12 months where they haven't got to pay any VAT, but they do get the VAT repaid. So in this example, we would look, our VAT cycle is February, May, August. We know at the end of August there's £1,582 owed. So all we would do in September, if we wanted to reflect that, we would put that number in there. And we then know at the end of November that there'll be a further repayment due. And again, we'll just put that number in December. So if you wanted to reflect that, that's how you would do it to account for the amount of money that was coming back into the business. I'm just going to reset it to the point where it's just following the VAT cycle. So that's my VAT. So 3 things you need to worry about really: output VAT rate and input VAT rate, and then when are my payments or repayments going to happen. I've then got my receivables. So the way we approach this is we look at what proportion of receivables that I would have generated by the end of the month have I received in the month. And again, the process is very similar to the VAT calculation above. It looks at my opening receivables, which I get from my balance sheet, which are the receivables which I've classified here. So at the moment, we're showing a figure of 76,452. If I wanted to classify my rent deposit as a receivable, I'll change that to receivable, and that number would then go up to 91. So that's the impact that has. I'll just undo that. So I know I've got £76,000 worth of receivables. I'm not generating any sales in April, so there's no revenue, and then there's no VAT on the revenue. The bad debts is accounted for within this line as well, so it will reduce your receivables. But in this business, I've got an opening receivables. I've got no increase in my receivables. Therefore, my closing receivables is the same in the first month. And I then assume, well, what proportion of that would I have received in the month? Now, what I'm assuming here is that I'm only going to receive a really small proportion of what's owed to me, because a lot of my clients are going to be in the same position that I'm in. And that will obviously be very different business by business. On average, 50% reflects 30 days. So I know for this business, if I just look down here for reference, my accounts receivable days in the last year ran at 30. So I know normality is roughly 50% for this business. However, I'm going to be hit hard over the next 12 months. And I'm only going to get back to some sort of normality by June of the following year. Because I'm just assuming that in this instance, a lot of my customers are in the same position as I am. We then flow the similar assumptions through to my accounts payable. So again, I've identified my accounts payable as 57. So I know I currently owe 57. I know what my purchases are, so my overheads and my cost of sales. I know what the VAT is on those purchases because I've already calculated that. And therefore I know that what my total payables is going to be by the end of the month. So here I've assumed what proportion of those payables am I going to pay. So if I operated a business that solely dealt with instant payments, i.e. cash or card, and I had everything on direct debit, these two numbers would be 100%, because you would receive everything you generated in the month and you would pay everything you've accounted for in the month. Clearly, most businesses don't operate like that. They operate a mixture. So here I've assumed for payables that for the next month, I'm only going to pay 25%, and I'm going to get back to my rough 30 days assumption from October onwards. So they're all of my assumptions. And then all we need to do is, okay, we'll go back to the key figure on here, which is, if we go down to our balance sheet, is our cash position. So I'll look at our cash, and I know I'll start off with 34,000 cash, which is my bank account of 26 plus my PayPal account of 8. So I've got my cash position, and I now see the impact of all of my assumptions. So my trading assumptions, my balance sheet assumptions, my cash flow assumptions, all they have on our cash balance. And here we can see that let's assume we've got an overdraft. We're going to start to go into our overdraft from June. And then we're going to get steadily worse as we go on. So I don't know, we may have a 10 or 20 grand overdraft. We're very quickly going to eat away at that. We're going to get to a point where, you know, as Mike said, a lot of businesses have just gone for a bounce back loan. Well, I very quickly got past the point of a bounce back loan, because that's only 50 grand. And now I'm heading into, right, now I'm into the world of Receivables now, where I need to start applying for a little bit more. And I look at my cash balance, and I can see I get to a negative 136 at February. That recovers slightly to reduce to, so I get slightly cash positive again from December. I don't know if you noticed it in the trading of the business, but this was a seasonal business, and therefore although I've got back to positive in December, actually I'm back negative again by the end of the year, ever so slightly. So it's now taken me 2 years from now to have a zero balance, effectively, cash. So this is a business which is in requirement of some funding. So again, what I've done now, I'm still in my forecast. So I prepared my trading forecast, and if I wanted to stop there, I could do. And I could just print out the report, and this is what we're planning to do in the business going forward. What I've then done is I've added my balance sheet and my cash flow assumptions to that. And now I understand a lot more detail about my business, particularly over the next 12 months, but I've also got that over the next 5 years. I can see now that I do need some funding. And now I need to look at, okay, well, how do I account for that funding requirement within this proposal? So what I now do is I now use my blue tabs. Now I'm only going to focus on this funding three-way forecast tab, because the situation that this particular business in only requires that. The purpose of the funding tabs is to essentially demonstrate the impact the funding has on your baseline forecast. So if the funding you are applying for impacts your trading position, i.e. you're applying for some machinery that will increase your output and reduce your cost of sale, you would reflect those changes on your funding forecast. And you'll see it's laid out very similar to the baseline forecast, where you just put in the assumptions, you override the assumptions with the new figure. As this particular example is just about mitigating short-term cash flow, all we're doing is going to apply for a loan. Our trading isn't going to change. So I go on to my funding three-way forecast, and all I do now is put in the additional assumptions for the new funding. You'll see that all of the other assumptions have just automatically pulled through, so you don't have to go and enter those again. All you need to do is reflect the new funding requirement. So three things that I do. I put in the amount that I'm looking to borrow. So again, I've assumed here I think we got to negative position of 136. So I'm borrowing 150, not leaving an awful lot of room for contingency. So I might want to increase that, but I've put 150 in. I'm assuming I'm going to take the full benefit of our 6 years loan, of which the first 12 months is going to be or the interest is paid by the government, and then I don't have to make any capital repayments. So payment and interest free for the next 12 months. So actually, all I need to do is go to my interest line, and from June onwards, I'm going to input 3.9%, because that's the rate I assume. Again, you have to be different for different businesses, different banks, etc. But this loan is going to be at 3.9%. And then I'm going to start to repay. So it's over 6 years, but I've taken the year capital repayment free. So actually my repayments are over 5. I've got 150,000, so I'm repaying £30,000 a year. And I just reflect that by month from June onwards of £2,500 a month, and then 30,000 in year 3, year 4, and year 5. The two differences, or the two changes this will have on the business is, clearly what we will see is an interest charge start to appear on the accounts from June of next year as the interest repayments start. And we will also see on our balance sheet, we'll see a debt position going from the 5 we originally had, that all being repaid in May, new loan coming in June, and then that loan slowly being reduced over the period of the forecast, to the point where at the end of year 5, I've only got £35,000 left on that loan. And again, we'll go back to our cash line now, and what we can see actually is that our low point is, so it's still February, but that low point is now just under 14,000 rather than the minus 136 that it was. So that's how we show a business that was performing well, is going through a really difficult time, but is able to come out of it at the end. We can't really just print off loads of pages and shove that under someone's nose and go, there you go. We actually need to present it in the right format. And to do that, it's really simple. You just click this Generate Funding Proposal button. So you click that. What it will do is ask you where you want to save it. So I'm just going to save it to my desktop for now. What that's doing now is it's pulling together all of your history, pulling together all of your assumptions to create the funding proposal document. And this document follows a methodology called the Campari methodology, which is the methodology that most lenders use to assess applications. So we don't just look at the numbers in the model. We look at the context within which the numbers were set to give the lender the comfort in not only the numbers but also the business and the business owner. So I'm just going to find where that file was saved, click to open it, and then this is the document that you would send to the lender. So we had Santander look at this last week, and they said that that is exactly what we get our advisors to complete on behalf of our clients for loan applications. So That's a big tick in the box. They've looked at that last week and they've said that's exactly the same. So what it's about, as I've said, is it's about putting the loan in the context of not only the business but the but having comfort in the application and in the owner as well. So we're going to need some information, some further information that we can't get from the accounts. So we're going to need to lay it out in a format that makes the flow of the story easy to understand. So again, there's an explanation on each of these boxes. So when we're not just saying write an executive summary, or we're not just saying give a company profile, we're telling you how to do it and what information you should include. So exec summary, really brief. How much do I want? Why do I want it? What's it going to be used for? Company profile, so talking about the company history, talking about where we are today, talking about the market, target customer, the segment you operate in, any other information that's relevant. Where we can pre-populate, we will do. So, for example, the financial performance of this business is automatically pre-populated because you've updated all of the history. And that's where those 5 years that we entered come into play. So we give an overall view of revenue performance over the last 12 months, the last 5 years, and profit as well. If I want to keep that commentary, I can do. If I want to add to it, I can do. Or if I want to completely replace it, I can do. You can put in whatever you want. I'm going to go with the pre-populated commentary. I've then got a graphical representation of performance at a high level over the last 5 years. So revenue, gross margin percentage, net profit and net profit percentage, and then finally a breakdown of the net worth of the business. And then we've got, again, the trend over the last 2 years by month, just showing the seasonality of the business. And as you can see here, this business does really well in the summer, not so well in the winter months. Finally, what we need to do to set the scene and set the context is a SWOT analysis on business. And again, we're looking for the key 3 to 5 internal strengths and weaknesses and external opportunities and threats. And again, if I'm unsure on what to include and how to include it, there's an explanation of how to do it on the right hand side. I look at my funding requirements, so I know that we need 150. That's over 6 years, and then I just need to identify a breakdown of that 150. So within our calculations, I think we had 136,000, which was to mitigate deficit. It might be a bit more descriptive than that, and 14,000, which was for contingency. So that's all we do there. Again, if you've got more elements within there, be as detailed as you can to give as much information as possible. So we've set the scene. We talked about the business, talked about the historical trading performance, understood what the strengths, weaknesses, opportunities, and threats are of the business. We talked about the funding that we require, and we now articulate the impact that funding has on the business. So here, and again, this will automatically be populated from the performance piece. This funding doesn't have a big impact on the P&L. It just is a bit of extra interest. So there's just a small impact on our overheads. The important thing is that our cash flow is now expected to increase from what was minus 136k to 14k. And then it'll have outstanding debt at the end of the 5 years of £35,000. Again, if I want to keep that, I can do. If I want to overtype it, I can do. You can put in whatever you want. Input your key forecast assumptions. And then we've got some graphs which reflect the impact the funding has on the business. So the way this is presented is you've got your baseline, which is your forecast that we set, and then we compare that to the with funding scenario. And here we can see, from a revenue and profit perspective, there isn't much of an impact because this particular investment didn't impact the trading of the business. However, it had a big impact on the balance sheet in that our cash balance is now positive in each of the next 5 years, whereas previously, had we left things as they are, we would have been in a negative position in year 1 and also at the end of year 2. We then demonstrate by month for the next 2 years that we forecast, and we just show again revenue and profit over the next 2 years by month for this business. And here for this particular example, we can see here we're literally making a profit in one of the next, I think, about 14 months. If I want to add any other information, there is another information section. If you don't feel it's been included above, and then I'm presented with my appendix, which includes my detailed P&L, balance sheet, cash flow, and working capital schedule. All you then do is you then print that out, and you'll notice that none of the tooltips are on the printout, so that doesn't go with the print. And that's a 6-page document. It just goes to the lender with the proposal to give them all the information they need about your business and the funding requirements. Thank you for paying attention. I appreciate that was a lot. It's a lot for an accountant to sit through, let alone a non-accountant. But hopefully that was beneficial. So I will hand you back to Mike, who, if I stop sharing my screen, he will hopefully share his screen.
Thank you very much, Mark. I did warn everybody that there's an awful lot of detail, but hopefully you'll appreciate that it was needed. And obviously, if you're going to plan your future, let alone if you're going to apply for funds, as I said earlier, I do think there's some people who have actually, and understandably, because of the uncertainty and how do we know what's going to happen? You don't want to take on loans. We're a program not to avoid debt if we can. So we don't want it. But I think the reality is for a lot of us to stay in business, we probably will have to consider the question of debt or more equity, perhaps, whatever. So we've got one of the people listening today is an insolvency practitioner. So he's probably rubbing his hands, waiting for it to go bad. But we do need the detail. We're going to do all the what ifs. And so what Mark has done is shown you all the different what ifs. So you start with the base, and then that's giving you your history. Then you just say, right, okay, what are the things that are going to happen on the first 24 months? And you can play around with the percentages on your margins, looking at all your figures, clearing out a whole load. So you're working on that, then look at your balance sheet and impact on your cash flow. So it's all very logical, and that's lovely, that bit at the end where, having done all that, you can look at it and say, yeah, I'm going to go back. I need to go back and revisit that. So all you do, just go back and do it again. So, and if worse comes to worse and you want to have 3 versions, save a copy and then start again, do another copy. So you could have 3 different versions if you want to, but obviously only one version presented to a funder. But if you're doing it for shareholders and saying you're wanting to look good, better, best, or worse, average, and then optimistic, whichever way you want to do it, you can take that approach. So let me unmute you all and say, has anybody got any questions? You're all unmuted now. Anybody got any questions? Can I pick on you, Tracy, as the person I picked on earlier?
I know. I mean, no. I think we, with the help of Andy anyway, did a 3-year cash flow forecast for the bank when we applied for a bounce back loan. Yes. For both businesses. And so one thing I would ask is if I did it this way, because obviously it seems to be much more detailed, for cash flow purposes, is it possible then to have actuals against it to see how you're actually faring against the forecast easily?
What you'd have to do is adapt the model. For this one is actually not actuals. It's not an ongoing one, but that is actually being developed as well. So as Mark was saying, this model is developing all the time, and we're having active involvement. So we're looking at the margin situation, we're looking at the VAT situation, because at the moment, so on the margin one, so for example, Tracy, on rentals in your game, so for everybody else, Tracy is into property, so both in terms of finance, both in terms of selling houses as well as renting houses. So there's going to be different margins in the different areas. So in your case, you might well have different lines of income with different margins. At the moment, the model just allows for an average, but we're going to make sure that you can actually be specific and look at the margins on your sections of income, shall I say, so contributions from each section.
Yeah, and on your forecast, obviously you're making assumptions, and are they literally just assumptions that you just conjure up yourself, how your gut feeling of it, or are you sort of taking your assumptions from anywhere specific?
Well, the assumptions that Mark's taken there do cut in market, but they're based on the history. So, for example, the reason why the history is so important, it gives the average recovery rate, the average margin percentage, etc., the average VAT rate, just based on the history. So, okay. And then it says, right, look, that's what your history is telling me. You there go and change it if you know different. So, and I think in any forecast, that's always the thing. But I think it makes it, a lot of people will produce forecasts of the future and never include the past when they're doing it. This is actually so much more powerful when it's got the history provided in there.
Okay, cool.
Mike, can I ask, in your experience of submitting these to the banks, is it better to be pessimistic about the depth and length of the effect of COVID, and it come up with a fairly substantial loan requirement, right? Or an element of what Mark did there is he just literally took the low point, said, right, cover that, right, and then you could see that he was generating cash all the time thereafter, even though he still got that loan. So the bank would look at that and say, right, okay, well, he's got this loan repayment, but he's still got plenty of cash buffer in years 2 and 3. Should his recovery be over optimistic? Have you got any thoughts on tactics?
Yeah, it's interesting because last week we had somebody with £500,000 in the balance sheet. And that £500,000 was earmarked for an acquisition because they're in the hospitality sector. And so they're saying, well, those targets are still there. We need to keep our powder there, but we're going to need to have operating money. So I've actually had to go to the bank and say, what is your attitude? And they were totally thrown by that because, in theory, the money is meant to be to keep people alive. And so if you've got £500,000 in the balance sheet, in theory, you don't need any money to keep you alive. But they took on board the fact from an operational point of view, well, we could use our money to keep alive, and then we're going to come to you and say, can you lend us some money to buy these targets? Of course, the worry is that the bank suddenly get tired of it because maybe the guarantee situation changes and they might say no. So we want to actually make sure we cover ourselves by having the money now so that our hunting pot is still kept clear. So maybe part of it is to actually get rid of the money out of the company now without taking it as a dividend. That's the problem. So the reality of your question is always never be over pessimistic with banks, because I don't believe banks fully understand accounts. So they look at the figures that you give them and they take it as gospel. So you've got to earn the credibility. So Phil Wood is there chomping away, just he will have an opinion on it, but you've got to show your credibility by looking at the position of where you have been and giving a rationale of why you think you've been there, and so how you've thought about the downside, you thought about the upside, and you think you've actually given a reasonable scenario.
Yep, thanks.
And remember, under the C-bills thing, if you end up with too much cash, you can repay early.
You pay it, yeah.
So that's the other argument.
Yeah, I think for me, it's that threshold of when you start hitting personal guarantees. That's when it.
Very much so. Yeah,
it all gets a bit difficult.
It does indeed.
Can I ask you a question on that, Mike?
Yeah.
And by the way, it's homemade vegetable soup. No sins.
I thought you had a Mars bar there, Phil.
That was earlier. Assume that Robert's got a personally guaranteed overdraft of 100 grand at the moment, and he's not sure about the future. So he applies for and gets a CBILS loan of, say, I don't know, 150,000, which has got no guarantees on it. So the balance goes from minus 100 to plus 50. And whilst the overdraft facility is still there in the background and guaranteed, there's no overdraft in existence. If he was to pull the plug at that stage, assuming he didn't intend that when he applied for the CBILS loan, obviously, what would your view be on that?
Well, I think the view is what we've been told, that if it's considered as abuse, then they would actually go to the people for potential fraud. But I think the reality is that there is going to be an awful lot of fraud, especially with the bounce back loans. That they're going to, unless it's so obvious that if there is a commercial rationale for anything that has happened, it's going to be very hard for them, and they're not going to want to spend lots of legal money. So I think it's going to be, if there is a bit of question of substituting, what they're saying is you can't have CBILS to substitute existing borrowing. So that's hence your question with the overdraft. Providing it's just there as part of the situation. If the prediction means that you don't need the cash and so that helps, fantastic. That just happens to be the way the cookie's crumbled. Do you agree?
Yeah, I do, actually. Yeah, I think it's wide open to abuse.
Oh, I agree.
And there are some people that would probably be well advised to pursue that line of action.
Yeah.
You know, and I guess you could work on the basis, if you don't ask, you don't get. So surely it's better to get it and then argue about it later.
Yeah, I agree. I think, it's like Tracy was saying, she's got bounce back loans, and of course you can get CBILS. If Tracy suddenly found that the housing market crashed on her and she's not ready to slit her wrists and she's prepared to hang in there for the future, then she might say to Andy, right, Andy, look, we do need to get a bit more finance here. We're going to have to go to a CBILS situation and we'll repay the bounce back loan. But what we can't do is have both. And we then have a situation of actually being able to go to the banks and say, look, this is the situation. That was our belief at that stage. We're now going to, we're now changed our mind based on events that have happened since.
Yeah.
And as I said earlier, I just think from a business point of view, it behoves us to assume the worst and just hope it doesn't happen. So that if too many people around what I'm seeing are just saying, oh, that 50 grand will help us and that will be enough. And I'm just saying, well, I can't see how you can actually come to that conclusion. You're just, what you're doing is burying your head in the sand and hope that you don't need to go with cap in hand later. And I think that's where the detail, because when I look at the figures, I've seen some CBILS, I've seen a 250 CBILS loan. The forecast is absolute rubbish. But the bank, I won't mention which bank, have passed it through on the nod because they don't really understand it. It's astonishing. And the forecast doesn't even add up.
We've seen the opposite.
Yeah.
Some really, really good forecasts, some really good solid businesses that have been turned down.
Yeah, I agree. Yeah, we've seen that.
And others that are taking weeks and weeks and weeks to get approved.
Yes.
So it's almost luck of the draw, isn't it?
Yes.
If you want to laugh, I'm going to say I had a client, believe it or not, this is true, right, that reacted straight away to the CBILS loan when you think that the Bibbles hadn't been invented at that stage. They made a CBILS application for £6,000 because that was their next monthly pay run. And guess what? She came saying, "Help! I've run out of the 6,000."
Yeah.
I said, "How did you calculate 6,000?" She said, "Well, that's the monthly payment run. I thought it would all be sorted after a month."
Yeah.
So,
I think that's the reality, and I think when you talk about 5 years, and that's what I love about this model, is that you've got 2 years of detail and then 3 years in total, which I just think works in a very sensible manner. And it just shows a bit of logic. Now, whether or not you're right, nobody can possibly be right. Otherwise we'd all be millionaires if we're able to predict the future. So we just got to show that there is some credibility in the way we're approaching it. Okay, anybody else got any questions? Emma looks as though she's desperate to ask a question. No?
Do you think if you don't actually, as a customer, you don't actually need any more finance, or you don't think you do, or will at this stage, is it still worth doing this exercise, do you think, or do you think it's only worth doing it if you want the loan?
No, I think it's definitely worth doing the exercise, Tracy, because it's like all these things. If you suddenly find, oh my God, we're going to need this money, the sooner we do it to earn the credibility, or the sooner we're having conversations, or just having conversations. What if we applied? So you've got a good relationship with the bank. Just make sure that they're aware of it. Say, look, we might be coming to you. We don't need it at the moment, but we might be coming to you. And then it's not a surprise. It shows that what banks like. And I say, I'm not being rude. They don't understand it because they're not accountants, but they look at certain figures and they're expecting to be presented in the way that they can understand it, because they are rushed off their feet. And so they're looking at the big picture, and they're looking down there, they're looking at the rationale that's presented to them.
Yeah.
So,
I mean, as a business, we've cut back everywhere, every which way we can. And, to be honest, even without the bounce back that we had, we've got more money in the bank now than when this all started, because of just being so cautious. But I just find, in my industry particularly, very hard to know exactly where it's going to go. And my concern is, when I did my presentations to the bank, because I did apply for receivables on one of them first, and I switched it. I did do the 3-year forecast, but I did 3 of them, as you said. What I'm optimistic for, what I think is probably going to happen, and what's the worst case. And it was the worst case that I presented to the bank.
Yeah.
And that's the one that got me the loan. But I think if I do this and I do look that far ahead, it does worry me that I'm going to think, bugger me, what's the point? I may as well shut up shop now and take the money I've got in the bank and pay back the loan that I've got and just take the rest of it. It's just it's a bit frightening.
But Tracy, that is a very sensible point of view, because I've literally got some people in the hospitality industry, say like those people with $500,000. It's a realistic question. Do we actually close and take $500,000? Because how quickly are they going to allow us to go and do big weddings and do outdoor events or whatever it is? Because I've got another one with $1.5 million on the balance sheet. And that's the question for him. Does he fritter it away? Because when the furloughing stops in October, and is he going to lay off a whole load of people, take the redundancy costs, or does he just say, enough's enough, I'm going to sit here, I've got to look after myself, and maybe I'll start the business again once the dust has settled? It's a really difficult decision, but in the end, you've got to look after yourself, because all your employees, they're not going to be casting any tears for you if you go down.
Mm-hmm.
It's hard to think that way, but it's
reality.
Yeah. Anybody else? Okay, so as I was saying earlier, what we've done is shown you how to do a 5-year plan and give you all the ability to actually create a funding requirement. Now, there's also an opportunity to do cost saving and opportunity analysis. So we'll send you the details of that. So what I'll do is I'm going to load the recording onto the website, and we'll send you a note when that's done. So that if you want to download it, then you're more than welcome. And we'll also send you a copy of the model. So remember, this is the universal model, but if, like Tracy, you're on Xero and you want it pre-populated, you just speak to us and we can do that for you. So it just allows you to, I just think, plan the future. If you wanted just to do it as a forecasting, there's a different model, Tracy, which is basically the same model, but without all the extra bits of the report generator that you can do. So I can talk you through that. Okay, so that's a challenge. If it's to be, it's up to me. The thing on my wall that's got somebody jumping off a cliff on their skis. I like to think that was me when I was younger, but you've got to, if you want something to happen, you've got to take action. You can't wait for anything. So it's really up to you. So I hope you've enjoyed it. And if you've liked what you've seen, those of you who are non-accountants, do spread the word. because there's an awful lot of people who are burying their heads in the sands out there who need help and are just ignoring what they need to do. So
Okay.
thank you very much. I'll just stop our recording.
Thanks, Mike. Thanks, Mike. Thanks, Mark. That was brilliant. Really enjoyed that.
Thank you.
Thanks, Mike.
Thanks, guys.
Okay.
Thank you very much.
Cheers.
See you.
Thank